Okay, great. Hello, everyone. First, I'd like to thank Chris for that great webinar, as always. My name is James Chen, and welcome to this webinar brought to you by fxstreet.com. Today, we're going to be talking about high probability trading setups, and I haven't been doing many webinars lately for FX Street. It's been about 2 months. Now, in that time, I'm proud to announce that I'm now at FXDD. And prior to this, for the last 5 years, I've been at another firm, FX Solutions. But now I'm the Director of Technical Research and Education at FXDD right here in New York City. So let's get started real quick. Today, once again, I'm going to be talking about finding high probability trading setups in the Forex market. And I'm going to be talking about a couple of different strategies that I use both for trending markets as well as for ranging markets. Now, this high-risk warning as well as the advisory warning. I'll give you a few seconds to read through that, and then we'll go forward. Okay, and as I always do, before I start my webinars, both here at FX Street as well as at other venues, as well as on our website here at fxdd.com, I'd like to give you a brief overview of myself, just in case you're not familiar with who I am or what I do. Now, once again, we are talking today about finding high-probability trading setups. And I'm going to talk about 2 different trading strategies that I tend to use probably more often than others, one of which is a multiple time frame trading strategy, and the other is a ranging type of strategy. But as you'll see, whether you're in a trending market or in a ranging market, the same types of principles apply. So whatever I'm looking at in a trending market, I'm pretty much also looking at in a ranging market, and I'll show you exactly what I mean in a minute. So let's go forward real quick. Let me just give you a little bit background on myself. Hopefully you can see that slide. If not, I'm going to talk briefly about myself. I am now the Director of Technical Research and Education at FXDD, which means I pretty much do the same thing I've been doing for the last 5 years at the other firm, which is give talks, both in person as well as on webinars. I try to educate traders as much as I can, as well as provide technical research or technical analysis on a daily basis. Now, I have been, for those of you who are not familiar with who I am, I have been an active Forex trader since the inception of retail Forex. This is pretty much going on about 10 or more years, and prior to that, I was trading also equities and futures. Now, if you've seen any of my analysis or any of my webinars, you'll know that I am almost purely a technical analyst. So I try to, sometimes I take into consideration the fundamentals as well, but for my day-to-day trading, for my, my entries, exits, et cetera, my risk management, it is almost purely technical. Now, I am a chartered market technician, or CMT, registered here in the U.S. with the Market Technicians Association, or the MTA. And I'm also a registered commodity trading advisor, or CTA, registered here in the U.S. as well with the National Futures Association. And I publish, as I mentioned, daily and intraday Forex technical analysis on fxstreet.com, as well as the great new social media website, forexstreet.net, which you should, if you haven't already, you should really take a look at. I have a blog on there as well as on fxdd.com. And you could take a look on fxdd.com or forex.fxdd.com, and you'll be able to see my new blog posts, which includes all of my analysis as well as some educational tidbits as well. Okay, so I've also authored numerous articles in such publications as Forbes, Futures Magazine, Technical Analysis of Stocks and Commodities Magazine, SFO Magazine. And by the way, this month, if you take a look at SFO Magazine, you go into sfomag.com. It's a free magazine. This is Stocks, Futures, Options Magazine. You'll be able to see one of my articles, and it's all about swing and range trading, a little bit of which I'm going to be touching upon today in this webinar. And I'm going to show you some live chart examples as well. Now, I'm also quoted on a regular basis by Reuters News, Dow Jones, Associated Press, International Herald Tribune, as well as many others. And once again, Bedros, I do apologize. It is a small window. I can't change it to normal. I'm on a netbook in this transition. Next time I do one of these webinars, I will have a full-size laptop to do it on. But for now, I'm on a little tiny netbook that I have. So, again, I apologize about that. Okay, so I am quoted on a regular basis by these and other news organizations, and I am the author of 2 books, Essentials of Foreign Exchange Trading, published in 2009 by John Wiley & Sons, and Essentials of Technical Analysis for Financial Markets, also published by John Wiley & Sons in 2010, last year. And I also, for those of you who saw the FX Street Awards, I'm very happy to say that that book, the second book, won for Best Book for 2010 at fxstreet.com. So thank you very much, FX Street. And also, I do also have a DVD set that's provided by FX Street, High Probability Trend Following in the Forex Market. And that talks a little bit about what I'm going to talk about today as well. So that's really enough about me. Let me see here. You can choose 2 times from the drop-down magnification on the HotCom window. Okay. Not sure I see where that is. But hopefully, you know, what I'm going to do is I'm going to go over to the charts in a minute. I'm going to give you a brief overview of how I look at the market, how I trade the markets on a daily basis, and then I'm going to go to my charts and show you exactly how I do that, and hopefully we have some time for some questions at the end. So, you know, feel free. Also, I'm going to provide my email address at the end in case you do have any questions, as I always do, and I'd be more than happy to answer any questions that you have. Okay, great. That's enough about me. Okay, so let's go on. Now, I talk a lot about, you know, for those of you who have seen me speak or who know me from the past, you know that I am primarily, I classify myself primarily as a trend-following trader, okay, and as opposed to a counter-trend trader, as opposed to a range trader. So that's how I usually classify myself. And, you know, will I trade with the trend? Absolutely. Will I try to avoid trading against the trend? Absolutely. At the same time, you know, will I trade ranges? Absolutely. And I'll show you exactly what I mean by that right now. But in terms of trend trading, a lot of people will say, you know, as a trend trader, as a trend follower, perhaps you're just trading breakouts, which I do a lot. And if you take a look at any of my analysis, you'll see that I'm looking primarily for breakouts. But at the same time, does that mean that I'm not looking for turns in the market? I'm not looking to trade turns in the market? Absolutely not. Basically, when you look at my strategy or my approach to the market from both a trending and a ranging perspective, so it doesn't really matter if it's a trending market or a ranging market. My perspective and my approach remains the same. And what is that? I'm looking for turns in the market, and after these turns in the market, I'm looking for breakouts. And if you want to classify what kind of a trader I am, that's what kind of a trader I am. I'm looking for turns, and I'm looking for breakouts. And I'll show you exactly what I mean and exactly how I use those principles when I'm trading both trending markets as well as ranging markets. So whatever you know, in terms of defining what kind of a trader you are, you know, I would stay away from saying, you know, I only trade in this particular way. What I'm looking for is I'm looking for context. It really depends on the context of the market. Whatever the market gives you, that's what you're going to take, that's what you're going to adapt to, or hopefully that's what you're going to adapt to, and that's how you're going to trade. So I'll show you exactly what I mean by that through these slides and on my charts. But essentially, you know, whether it's a trending market or a ranging market, my philosophy will pretty much remain the same. Okay, so let me first of all go through the trending markets. Now, whenever I'm looking for whenever I see a trending market, I'm going to try to look for opportunities. If there's a trending market, it does not necessarily mean that I'm going to be taking opportunities in that market. What I'm looking for is a context. I'm looking for different, triggers to get me into a high probability trade. And that is very, very key. I'm looking for high probability trades only. Just the fact that it's in a trending market, or just the fact that it's a nicely ranging market, does not mean I'm going to get into any type of trade. We as retail traders have the luxury or the ability to stay out of trading if we so choose. There are a lot of institutional traders out there that are forced to trade, that have to take trades. We as retail traders do not have to take trades. we wait for the right conditions to present themselves. And these correct or right conditions can occur whether in a trending market, a ranging market, or what have you. Okay, so let's quickly go through this, this background. Okay, in a trending market, I'm going to talk about what I talk about on a pretty regular basis. This is multiple time frame trading. Now, a lot of you may have heard me talk about this before. I'm going to show you, give you a quick overview and then show you exactly how I do it on my charts. And then I'm going to show you how this type of approach can also work on a ranging market and how I approach it with a few tweaks on a ranging type of market. Okay, so what is multiple time frame trading? Now, this is a type of trading that's it's a high probability methodology that is originally based on Dr. Alexander Elder's triple screen methodology. And if you take a look at any of Dr. Elder's books, you could see it on Come Into My Trading Room or Trading for a Living. The basic methodology is right there, and it just makes so much sense. And it's, for me, I've taken a lot of what, that strategy originally said. I made some modifications to it, according to the Forex market, and it works tremendously for me. As long as you have your risk management in place, it works tremendously. It can work very well for you. And then we'll talk about the ranging markets in a second. But this type of multiple time frame trading is used in many forms by many professional traders, including in the Forex market. Now, this is pure technical trading. As I mentioned, I am purely a technical trader. Now, what you're doing with this strategy is you're positioning yourself in the direction of the overall trend while pinpointing optimal entries. Now, what are optimal entries? Now, a lot of people say you buy on a dip. Absolutely. I mean, that for me is that sums up. It's a very simple way to put it, but that sums up how you want to get into any type of trending trade. So you're looking to buy on a dip, but not only you're looking to buy on a dip, you're looking to buy on a recovery of a dip or a recovery of a pullback. Now, the same thing applies to a downtrend. If you want to get in on a downtrend, if you want to go short on a downtrend, you're looking for rallies. You're looking for minor rallies within a downtrend, and you're looking to short those rallies. But not only are you looking to short those rallies, just because the rally occurs does not mean you're going to short it. What I'm looking for is a recovery of a rally, which means that it starts to go back down in the direction of the overall trend. So that's what I'm looking for. Okay, and this is purely technical trading. You're positioning yourself well with the overall trend. Now, what's very important about this, as I mentioned, we as retail traders have the luxury to stay out of trades if we so choose. And we should if it's not a high probability trade or if it's not what we think, should be a high probability trade. So this type of trading keeps traders out of low probability trades and puts them into high probability trades. How does it do that? Well, the general idea has three components. Number one is trend. Okay? Very, very important. Number two is a pullback recovery. Not just a pullback recovery. Okay? And this could be a recovery of a dip or a recovery of a rally. Number three, we're looking for a breakout in the direction of the trend. Okay? So as I mentioned before, whether it's a trending market or a ranging market, what am I looking for? I'm looking for a turn, and then I'm looking for a breakout in the direction of where I'm looking to trade. Okay? A turn and a breakout. In this case, in a trending market, I'm looking for the trend, I'm looking for a pullback recovery, a dip or a rally recovery, and then I'm looking for a breakout in the direction of the trend. And this type of trading also has solid, straightforward risk management. Okay, so let's go on real quick. Now, how do you choose your time frames? Now, once again, this is the trending strategy, multiple time frame trading strategy. How do you choose your time frames? I have three different time frames that I'm looking at, okay, for every given currency pair. And I'm looking at, around 20 different currency pairs. I have my three different time frames on all of these different currency pairs at all times, and I'm scanning through it. Now, how do you choose your time frames? I have three, once again. Number one, you choose a time frame that you feel comfortable trading, and you call that time frame intermediate. Okay? So let's say that I'm a 4-hour trader. Let's say I like to trade the 4-hour bar charts or candle charts, where each bar or candle is worth 4 hours of price action. Let's say that I'm that type of trader. I call that intermediate. That's the middle time frame. Now, how do I get the long-term time frame? Very simply, you multiply by 4 to 6 to get the long-term time frame. So 4, 5, or 6. 4, 5, or 6, I'm sorry. So, for example, once again, I'm a 4-hour time frame trader. That's my intermediate. How do I get my long-term? Let's say I multiply by 6 to get my 24 hours. And as we all know in the Forex market, 24 hours constitutes 1 day of price action. 1 day of price action, so that's the daily chart. So my long-term is the daily, my intermediate term is the 4-hour, and now how do we get the short-term? You divide the intermediate by 4, 5, or 6 to get the short-term time frame. So let's say, once again, I have the 4-hour time frame. I divide by 4 to get the 1 hour as my short-term. Okay? So in this particular case, what am I doing? I've got the daily, 4-hour, and 1 hour as my 3 different time frames for the strategy. Okay? There are a lot of different incarnations that you might want to use. If you're a longer-term trader, let's say you're a daily trader, which I also am. I'm a daily trader. So daily is your intermediate. You multiply by 5 to get the weekly, and you divide by 6 to get the 4 hours. So you got weekly, daily, 4-hour. Or you could, I'm going to show you a couple different examples on my charts in a second, but you have this different, you have the weekly, daily, 4-hour, or if you're a very short-term time frame trader, let's say you're a 10-minute trader, in order to get the long-term, you multiply by 6 to get the 1 hour, and you divide by 5 to get the 2-minute. Okay, that's just another possibility you could use. Or let's say you're a real long-term trader, and I don't think there are many of you out there, but let's say you're a weekly time frame trader, and you want multiplied by 4 to get the monthly, divide by 5 to get the daily, and you got the monthly, weekly, daily, okay? So this gives you a lot of flexibility. That's why we say 4, 5, or 6. There's a lot of flexibility here according to how you want to trade and how this works best for you, okay? So basically, you've got your 3 different time frames. Now what do? Very simply, you go, first of all, and once again, I have this all set up on my MetaTrader charts, and I'll show you that in a minute, but what do you do with these 3 different time frames? First of all, you're scanning the long-term time frames. Okay, so in this case, once again, I've got the daily, 4-hour, and 1 hour. I'm scanning all the daily charts, okay, for all the different 20 or so currency pairs, as well as the metals that I trade and other instruments that I trade. Now, what do you do with the long term? This is very, very important. This time frame keeps you out of low probability trades and gets you only into higher probability trades. How does it do it? Now, the only function of this time frame is to find the overall trend. And how do you find the overall trend? Now, first of all, if there's no trend, you're going to completely stay away from that particular currency pair, and you're going to move on to the next. Okay, it's very easy to do this. You just glance at the chart, glance at the long term. If there's no, if there's nothing there that tells you that there's a trend, then you're not in that particular trade. Okay. Now, how do you measure the trend, or how do you see if there is a trend or not? What I tend to use is what I call the correct order of moving averages. Okay. And I'll show you this on my charts in a minute. I use 5 different EMAs, or exponential moving averages. It's going to be the 10, 20, 30, 50, and 100. Once again, EMAs, 10, 20, 30, 50, and 100. Okay? I'm looking for separation of those moving averages, and I'm looking for correct order. In an uptrend, the correct order of moving averages will be the longest term moving average on the bottom, followed progressively higher by shorter term moving averages. In a downtrend, just the opposite. It's going to have the longest term moving average on the top, followed progressively lower by shorter term moving averages, with the shortest term on the bottom. Okay, and that is the correct order of moving averages. That's my main technique for looking at the long-term time frame for this strategy. Okay, now you could also use trend lines, which I often use, and you look at any of my analysis. Trend lines are far from an exact science, but then again, none of this is an exact science. So trend lines are one of the best tools you could use to define or frame a trend. Okay, and I use trend lines very often as well. You could also use the slope of single moving averages, including, as I mentioned, 20, 50, 100, 200, an SMA or EMA. In terms of, a lot of people ask me, what's the difference between an SMA and EMA? You know what? Not a lot. If you're looking for crosses, maybe, okay, maybe there's somewhat of a difference there. But in terms of, an EMA simply stresses the more recent price action, whereas SMA is equally distributed across all of the different periods. But essentially, when you're looking for slopes of moving averages or correct order of moving averages, there's not a lot of difference between an SMA or a simple moving average and an EMA or an exponential moving average. So what I tend to use is, I will use them interchangeably. Okay, so you could also, once again, you could also use the slope of single moving averages, or you could use the slope of the MACD histogram. And by the way, Dr. Elder in his books, he talked about the slope of the MACD histogram as his way to use it. I find it of less use than the correct order moving averages, but I'll show you all this in a second on my charts. Okay, now I stay completely out of non-trending pairs, as I mentioned. Okay, so I'm looking at the daily chart on all the different time frames, and if there's any non-trending pair, if the moving averages are crossed, or there's just not an environment for me to play that trend, I'm just going to stay out of that pair. There are plenty of opportunities to trade in the market. You don't have to force any opportunity to trade in the markets. You let the opportunities come to you. You find, if there is a high probability trade occurring or opportunity occurring, then you will take that and not before that. Okay, now if there is a trend present, you decide only to trade in that direction, and at that point, if there is a trend present, whether it's an uptrend or a downtrend, you go to the intermediate time frame. Okay, what do we do on the intermediate time frame? If there's a trend present on the long-term time frame, on the intermediate time frame, we use oscillators. Okay, a lot of people may say, oscillators don't work, and they're just ineffective, and they lag the market. All of that's true. Okay, I don't use oscillators to get into trades. Okay, but oscillators are good confirming mechanisms, and I don't really use oscillators the way a lot of people use oscillators. A lot of people say if it goes into overbought or goes into oversold, then at that point I'm looking for a turn in the market. No, you know what? Well, when price is trending all the way up, stochastics or RSI could be in overbought territory for weeks, for months, for however long you could wait. But so I don't use it in that way. But I use stochastics to help me gauge and help me confirm potential turns in the market. Okay, so on the intermediate time frame, in this case, it would be the 4-hour time frame. I'm using oscillators to gauge momentum and possible oversold, overbought turning signals in the direction of the overall trend. And how do I do this? Now, if on the long-term time frame, if the overall trend is up, I'm looking for turns to the upside from oversold. I'm looking for, okay, in this case of the stochastics, I'm looking for the stochastics to cross up above the 20 area. This is if there's an uptrend on the long-term chart. Now, if the trend is down on the long-term chart, I'm looking for turns to the downside from overbought. I'm looking for a turn down from 80. A cross below 80 from the high extreme, okay? Now, what does this do? This practice helps you find the optimal entry regions. Recoveries, I think I misspelled that, but recoveries of dips and pullbacks in the direction of the trend, okay? So once again, very important. On the intermediate time frame, I'm looking for recoveries of dips and pullbacks, okay? In an uptrend, let's say price action dips, okay? Doesn't mean I'm going to get in a trade just because it dipped, okay? It could be dipping, it could be changing direction altogether, okay? I'm looking for that dip to start showing me evidence or showing me a hint, an indication that it's recovering and going back in the direction of the trend. And that's what I'm looking for, okay? So what does this practice do? It finds optimal entry regions in the direction of the trend. So we're looking for recoveries of minor down moves during uptrends and recoveries of minor up moves during downtrends. And this just, to me, makes a lot of sense, and it works phenomenally when you look at when you use in this way. Okay, so the tools that you may use: stochastics, RSI, ROC, CCI, luminous percent R, or your preference. I tend to use stochastics, slow stochastics, and I'll give you my settings in a second that tend to work very well. Actually, it's just 1433 on the slow stochastics. But you could also use RSI, which is the relative strength index, or the ROC rate of change, CCI, commodity channel index, luminous percent R, which is basically fast stochastics, or really your preference. Any bounded oscillator can work well for this. Again, you're looking for a recovery of the dip or rally, a recovery of the pullback going in the direction of the trend. Okay, so now, once that cross occurs from overbought or oversold, once that cross occurs, what do you do? Now, what you do is you go to the short-term time frame. In this case, in my example, I'm going to the 1-hour time frame. And what do I do on the 1-hour time frame? I'm looking exclusively for pinpointing entries and exits. How do I do this? I'm using what we call a trailing entry stop. Okay, and this is a manually trailing entry stop. Okay, what is an entry stop? To the upside, if you want to get in, to the upside on a stop order, it's above you. Okay, the stop order is above you. If you want to get in on the downside on a short, then the stop order, the sell stop, is below you, below the current price. Okay, so on a buy signal from the two larger time frames, I'm entering using a trailing buy stop. Okay, and once again, this is provided that the long-term time frame is showing an uptrend, and the medium-term, the intermediate-term time frame is showing a recovery of a dip, a cross above oversold. So what I'm going to do is I'm looking for some type of an entry stop. Okay, and how am I doing that? I'm entering on a break of the previous bar's high. So once we turn to the short-term time frame, in this case the 1 hour time frame, I'm looking for an entry on the previous bar's high. Okay, so let's say last hour had a certain high. Okay, and this is the top of the wick, of the high wick in the candle. Now I'm looking for to play a breakout above that, and once that breakout occurs, I'm getting into the trade. Now, if instead of breaking out above the last bar, if price moves lower instead, I'm going to reset my breakout point to the high of the next bar. Okay, and so on and so forth. I'm getting in this way. I'm getting in at progressively better prices. Or in the case of if you're going long, you're getting in at progressively lower prices. So you're setting the breakout level at progressively lower bar highs until a breakout occurs, or the signal is no longer valid. Okay, what do I mean by the signal is no longer valid? What I mean is on the long-term time frame, maybe the trend has crossed. There's no more trend there. Okay, if you wait too long, that may happen. Now, on the intermediate time frame, let's say price action has gone all the way to the top to the overbought area already. So at that point, you're not going to take this trade. Okay, so there are many opportunities to get out of this trade, not to take this trade, and that's a good thing. Okay, you only want to take, when the stars line up for you, when the trade is higher probability, then you want to take that trade, and that, I think you'll find a higher chance of success with that. Okay, so the reverse is true for sell signal. I'm looking for a trailing sell stop. The long-term time frame and the medium-term time frame are telling me to go short, so I'm looking to play a breakdown of the last bar low. Okay, and if that occurs, I'm getting into the trade. If it doesn't occur, if the next bar is higher, okay, I'm going to set the new breakout level at the low of that bar. And then if it goes higher, until I get into the trade, or until the whole trade setup becomes invalid, I'm going to keep setting my my breakout entry higher and higher. And in this case, if you're going short, setting your breakout entry higher and higher, you're getting in at progressively better prices. Okay. Okay, so hopefully this makes some sense to you. Now, once the trade is entered, the initial stop loss can be set at the breakdown below the previous swing low for a long, and then reverse it for a sell. Okay, so let me show you. I'm not sure if I'm going to have a lot of time to go to my ranging markets one, but let me show you real quick. Talking about when I. Okay, so let's go ahead and show you my charts. Now, let me pull up real quick my profile, and hopefully you can see my charts here. Okay, so this is what I'm talking about. And I'm not sure if I'm going to have enough time to go through the ranging markets, but if not, I'm gonna try to do 2 webinars a month on FX Street if possible. So I'm going to be doing more frequent webinars, so I'll talk more about the ranging markets perhaps next time if we don't have enough time today. But okay, so real quick. Now I've got 3 different time frames here. I've got my daily chart. Okay, I've got my my 4-hour chart and my 1-hour chart. This is euro dollar. Okay, so let me first take my daily chart. Now, what am I looking at here? First of all, I'm scanning through all my different currency pairs, and I'm looking for some kind of trending indicator. So in this case, once again, I've got the 100 period, 50 period, 30 period, 20 period, and 10 period exponential moving averages. And in this case, I'm looking for separation and correct order. In an uptrend, as you can see here, the longest period moving averages on the bottom, followed progressively by shorter moving averages as we go up. So this is the, this is what I'm looking at. And in any case where we have this type of this type of trending capability, and this once again is on the daily chart, then I'm looking to the intermediate time frame to see what might be going on there. So now, as we can see over here on the left, you could see that there's a lot of crossing and not much separation, and that for me is a non-trending market. And at that point, I'm not going to do anything with this particular currency pair. So as we can see here, we see right over here, this arrow here that we see, also a lot of other places along this line, but here, just to illustrate this for you, I'm showing you right here that we have a trending market. Okay, so now, once we know that we have a trending market, let's move on to the 4-hour chart, and let me make that bigger for you. Okay, now, once we know we're in a trending market, what do? We look for the intermediate time frame. In this case, it's the 4-hour time frame. Okay, and I'm looking for a recovery of a dip. So we know that after price action dips, okay, we're looking for a recovery of a dip, which for me would be confirmed by a move up on the stochastics oscillator. And as you can see here, this is 1433. A move up to the upside, crossing above the 20 line in the case of stochastics. So once that occurs, once that move occurs, that cross occurs, then I know that I'm looking at what potentially may be a recovery of a dip in an uptrend. Okay, so once that occurs, once that cross occurs, and after that closes, after that particular bar closes above the 20 line, in that case, I'm going to be looking towards the short-term time frame. And in this case, my short-term time frame is the hourly chart. And what am I looking to do? And as I mentioned before, I'm looking to get in on a trailing entry stop. In this case, if you're going long, you're looking for a trailing buy stop. Okay. Now, what is a trailing buy stop? Okay. Now, let's say if you could all see this little green candle here. Not this little green candle, but this green candle right here, okay, where this green line is, okay, that's my entry. So I want to get in on a break above that, okay? Now, as you can see, and this is all on the same time frame as the long-term, the daily chart and the 4-hour chart. So I simply, once I saw that the conditions were right, I moved to the short-term time frame, which is the 1-hour chart, okay? So once we see this, I'm looking for a breakout above this last bar, okay? Now, the next bar does not break out above that. So what do? I'm simply going to move my breakout point lower. Okay? Can you see that you're getting in on a progressively better price there? So instead of breaking out above this one, now I'm going to break out above this one. What happens there? It breaks to the upside. It breaks out above this high. And I got in at, just a few pips better, but a few pips nonetheless, okay? So as much as you could do for yourself in terms of your profit picture, is better. So if you could get in on a break above slightly lower, more power to you. I think that's it really helps there. Okay, so now you get in on a breakout above the last bar high, okay, and you get in that, and where do you put your risk management? I would put it below the last major low. In this case, would be right down here, okay? And that's where my red line is, and you could set your stop loss there. And then once you get into this trade, you could get in, you could manage it using, you could trail your stops, or you could take a profit target, depending on, based upon prior support, resistance, etc. Okay? Okay, so let me, that's the euro dollar. This is sort of a historic chart, but, I was just trying to get some good charts for you to see. Now, if you take a look, let me go to the next one here real quick. Okay. This is dollar yen, okay? Same type of deal here. Now, this is a downtrend. I've got daily, 4-hour, 1-hour here, okay? Let me make my daily bigger. Okay, so as we can see here, we got a good separation, correct order moving averages on the downtrend, and this, to me, it's a downtrend. It's it's not a non-trending market. It's not an uptrend, and it looks to me like a very strong downtrend. So we have a point here where we take a look at within this downtrend on the daily chart. What do? We move over to the intermediate chart. Let me make that bigger here, and this is very clear here. Okay, it rallies. Okay, within this downtrend, it rallies, and then it once it rallies, it goes above overbought, and then it crosses down below the 80 line. That for me is a confirmation. I wouldn't get in on a trade just based upon an oscillator alone, but for that for me is a confirmation that perhaps this rally is recovering to the downside, and we are gonna, hopefully we're gonna get in on a short trade within the direction of the downtrend. Okay, so we got to cross to the downside. Once we see this, what do? We move over to the 1 hour chart or the short-term chart. Okay, we're looking for some type of a breakdown. Okay, and we're looking for a breakdown below the last bar high. Now, let's say that breakdown occurred. Let's say that we're looking for this breakdown right here, below this green candle right here. Okay, let's say. Okay, now it doesn't happen. So let's move it up. The breakdown does not occur. I'm sorry. I'm still trying to get used to MetaTrader. I used to use another charting package before. Okay, so once we see that it doesn't break down below here, I move it up. Now, if the candles kept moving up instead of breaking down below the prior low, I'm going to keep moving my breakout point or my breakdown point at progressively higher or better prices until I get into the trade or the long-term or the intermediate-term signals become invalid. Okay, so that's what I'm looking to do. So I have a breakdown here. It breaks down. I put my stop loss at the last major high. In this case, it would be above here. Okay, and then I could play that with a profit, either a profit target, or I could, once I get into the trade, I could at least move my stop loss to break even. And then from there, I could possibly manually trail my stop losses and try to lock in as many pips as I can. Okay, great. So let's go on real quick to show you a couple more examples. Okay, now in this particular case, this is the euro dollar, but they're different time frames: a 4 hour, 1 hour, and 15 minutes. Okay, so on the long term is 4 hour, intermediate term is 1 hour, short term is 15 minutes. This is for you. Many of you are shorter-term traders. So first of all, you take a look at your long-term time frame, and what do you see? You see there is a dip within an uptrend, correct order of moving averages, separation between moving averages. What do you do then? You move on to your intermediate time frame, in this case, the 1 hour time frame, and you're looking for, in this case, it touches the oversold, okay? But once it touches and bounces off, after that closes, I'm looking after that. That prints, the stochastics or, and the price prints, then I'm looking for the next, the short-term time frame, which is, in this case, is a 15-minute chart. And once again, I am looking for a breakout entry, a trailing breakout entry. Why is it trailing? Once again, we move the breakout entry lower and lower until we get in at the best price we can. Okay, sorry about that. Okay, so what do we have here? It doesn't break out above this little shooting star here, okay? So what do? We move it down a little bit. Doesn't break out above there. What do? We move it down a little bit more, okay? And at this point, there is a breakout, okay? There is a breakout above this one. It's not a great breakout because there's not a lot of momentum behind it. It's a breakout nonetheless. And I'd like to, ideally, I'd always like to have breakouts with momentum. Of course, that's what we're all looking for as breakout traders. At the same time, you're not always going to get it. Okay, so there's a breakout, and then it sort of consolidates there. I hate to see that, but I've got my risk management in place again, and in case it goes against me, I've got my stop loss down here at the last major low, and that's where I'm going to get out if it does indeed go against me. It does go against me a little bit, but then it starts to take off. If it went against me, hit my stop loss, I'm out. I move on to the next trade. Not a big deal. I've got my risk management in place, and the potential for profit is rather large. My risk-reward ratio is rather good, so I know I'm covered. Okay, so next couple before I think I may be running out of time, but same type of thing. This is Aussie dollar, daily, 4 hour, 1 hour. I look at the long term. I've got my correct order of moving averages. Okay, I go to my intermediate term, my 4 hour chart. It touches the oversold, and then it bounces back up. On the printing of that candle, on the printing of that stochastics, I'm moving down to the 1 hour chart. I've got my trailing buy entry It doesn't break out above the shooting star here. It goes down instead. I'm looking for a breakout above there. It breaks to the upside. I got in at a better price. I placed my stop loss down here, and I'm pretty good to go right there. Okay, so last one here before we briefly touch upon ranging, and then I got to go. Actually, the next speaker is my friend and colleague, Greg Michalowski, and who's actually my new colleague here at FXDD. So I've only been here for less than 2 weeks, so I am quite new here. Anyway, so I'm sorry. Let's go to dollar Swiss. Okay, this is if you're a longer-term trader. If you're a daily trader, you go to your long-term chart, your weekly chart. You've got your correct order moving averages to the downside. You move to your daily chart. What do you see here? A move down, a clear move down from overbought and stochastics. That's a clear recovery of a rally. And to the downside, once this breaks to the downside, what am I doing? I'm going to my short-term chart, in this case a 4-hour chart. And then that is a breakdown below. I'm looking for a breakdown below there. If it doesn't break down below there, I'm moving my breakout level higher. Okay, and then it finally breaks down and it gives me some good momentum. Okay, so that's the basic idea there. Let me quickly go back to my charts. But okay, in ranging markets, basically, you're basically looking at the same thing, and you're looking for a backdrop. And in terms of a range, I'm looking for some kind of a channel. Now, if you have a slight uptrend channel, slight downtrend channel, it's for me, it's also a range. Okay, and it's much the same as a horizontal channel. They're all pretty much ranges. And what am I looking for? Much like what I'm looking for in any type of a trending market, I'm just looking for turns, turns and then breakouts. So I'm looking for in a ranging market, I'm looking for when it gets to, let's say, the bottom of an uptrend channel, I'm looking for some kind of an indication that perhaps there will be a turn, and this can include, as I mentioned here, an oscillator cross of overbought, oversold. It could mean a price oscillator divergence or a reversal candle pattern like a hammer or a shooting star. And then once I see one of these turns, or preferably more than one of these turns, these indications, then my trigger is a breakout play. And in the case of some type of a channel, whether it's a horizontal channel or an uptrend channel or a downtrend channel, I'm simply looking for a breakout of some intra-channel trend line. Okay? And this to me is it's a trending market, but it's also a ranging market. And if you take a look at a horizontal, a horizontal range, a sideways moving market, same type of thing, same principles here. I'm looking for, in the case of here, I'm looking for a dip within this range, and then, I've got the shooting star candle to give me, the hammer candle right here to give me some type of indication that perhaps there might be a turn in the future. And then I'm looking at the slow stochastics down here that cross above oversold. That's giving me another confirmation. And then where's my trigger? It's simply a breakout play. Much like what I do with the multiple time frame trading, I'm looking for a breakout play. And in this case, this is a downtrend, a counter trend, trend line within this uptrend channel. I'm looking for a breakout of that. It occurs, and that for me is a trigger. I get into the trade. In this particular case, it worked out pretty well. Someone asked here, please number the moving averages again, please. Yeah, Miguel, it's 100, 50, 30, 20, 10 EMAs. Okay, once again, the EMAs are 10, 20, 30, 50, 100, and that shows me my correct order moving averages. Trying Trader asks, if you are in a good trend up or down, would you only enter trade when the stochastics come back into overbought or oversold? This could take a long time. With this particular strategy, Trying Trader, yes. And I'm in no rush to trade, okay? I've got things going on different currency pairs. I've got different strategies going, and whether they're ranging markets or trending markets, I've got a lot of stuff going. So, yeah, I'm going to wait. I will wait for, in this particular strategy, I will wait for this setup to occur. So I will wait in an uptrend for stochastics or whatever I'm using to go into oversold and then emerge from oversold. And that for me is a high probability trade. I'm in no rush to get into any trade, really. I've been doing this a long time, and I'm not looking to rush in. But great question there. Ghana asks, how about 10-minute, 1 hour, 4 hour? Absolutely. 10-minute, 1 hour, 4 hour, that can work perfectly well. I happen to use 4 hour, 1 hour, and 15-minute because I like to use a 15-minute, but yeah, you can definitely use that. Boyke, can you show ranging slides? Yeah, I showed some ranging slides before. What I'll do is, if you have any questions, let me quickly put in my email address right here, my new email address here at FXDD. Okay. And as always, if you have any questions regarding anything I brought up today or at any other time, my job is education here as well as technical analysis, so I'd be more than happy to help you. Okay? So jchen at fxdd.com. Please feel free to contact me anytime, and I'd be more than happy to help you. And I wish all of you a great day. Thank you very much for your time.